Good morning, good morning, good morning. What up, what up, what up? It's Khalid Nathan Aleem, the real estate boy. And welcome to the bull ring. It's the bull ring. It's Friday, and we have a special guest. I'm just waiting for him to pop on now. I'm trying something different. Okay. I'm waiting for the brother to pop in here. This is my first time doing this. So this first time might be a little glitchy. So, but I got everything set up and I'm waiting for the brother to come in now. So today, what we're going to be talking about is I'm going to be interviewing a lender, a mortgage lender. So again, I'm just waiting for him to pop in here. I think next week and the following weeks, this would be a lot better. It'd be a lot easier. But we're just going to wait on him for a quick second to pop in here, and then we're going to get this started. Today, we're going to be talking about how to prepare to buy a home. When people come to me, a lot of time they want to buy a home, meaning that emotionally or intention, they want to buy a home, but they skip the first part. And it's just like when you're in school, elementary school, you go first grade, second grade, third grade, fourth grade, fifth grade, middle school, high school. A lot of people, we don't skip grades. So what people want to do, oh, there it goes. All right.
How we looking? Sound good? Look good?
Yep. I can hear you. I can hear you.
Excellent. Good morning.
Good morning. Good morning. So I was just giving you a quick intro here, letting the people know that when they look to buy a home, when they come to me, a lot of times they're not prepared. And they want to skip a step. So they want to jump over the finance part and go right to, I'm hearing an echo here. You may want to mute. Okay. Oh, I'm still hearing an echo. See if there's anything that I can mute on my end. Uh, okay. Yeah, there it goes. All right. So when people come to me and they're looking to actually buy a home, a lot of times they skip over steps. So they skip right over the finance part and they go right to, oh, I want to see homes. So what I wanted to do was bring a mortgage professional in here so I can ask him questions for you guys to get y'all started. So I got my man, let me unmute you. All right, I got my man Shad Hammonds here. Is Hammonds or just Hammond?
Hammond with just the Hammond.
Okay, just Hammond. All right. So I wanted to bring him here. Let me tell you how me and him met. I was doing a deal, and I had a lender. I had one lender, and he wasn't working too good. So the buyer was like, "Hey, I got this other lender." And at first, I'm like, I don't really want to deal with anybody else. But she was persistent and she was just like, all right, well, no, I'm going with this lender. He's coming out to my table and he's sitting down with me because she was an older woman. So she told me as far as him coming out there, sitting down at the kitchen table, and a lot of lenders don't do that these days. Everything is kind of through email or through DocuSign or through the computer or through the phone. But when she told me that, I was like, listen, I got to meet this brother because it seemed like it's somebody that has the same motivation that I have. Brother came out to my open house, sat down, busted up, and we've been doing business ever since. So again, he's a mortgage lender. So I'm going to let him introduce himself and tell you guys about himself. Why don't you kind of introduce yourself as far as what you do now and you know what I mean, kind of take us up to this point in your career.
Absolutely. So my name is Shad Hammond, team leader at Loan Depot, and appreciate the introduction. And it's crazy because we have been doing some business for a couple years now, and right away I knew that he was aggressive. Khalid was a closer. Khalid was an advocate for his clients, the clients that he serves. And in the marketplace here in Philadelphia is something that we know that a lot of home buyers don't have the support system that they need, whether it be before they meet us or even ongoing during the process. So home ownership. I've been an advocate. I've started several different initiatives, both on a local and national level, to foster home ownership, not only amongst all of us, Americans, but also again with people of color, because there's definitely a wealth gap, a home ownership gap, and I think it needs to be addressed. So I've been in the business now for about 8, maybe 9 years, give or take, and I've closed over 1,100 loans in 39 states.
Wow.
I worked for a big national lender for quite some time, and then now, more specifically, I've been working locally because I want to help where I shop, right? I want to help the folks in my backyard. So I now service PA, New Jersey, Delaware, and Maryland, anywhere I could pretty much drive to and be able to have that cup of coffee with you, or be able to sit at your kitchen table and go over things if we need that type of hand holding. So it's again something that I'm very passionate about, and it's something that I love what I do.
Awesome, awesome. All right, now you're from Philadelphia, correct?
Absolutely, absolutely. So I'm from the Baltimore Avenue corridor of West Philly, University City, Cobbs Creek. I now live in East Mount Airy.
Gotcha, gotcha. And you went to Central,
Masterman.
Masterman. Okay, okay. Then graduated and went to Temple.
Yep, yep. Temple did
Yeah.
undergrad and grad at Temple.
Okay, okay. I remember back. I think we're around the same age, but
Yeah,
back when I was growing up, and I know the TO alumni gonna hate this, but it was like you going to Temple, you going to 13th grade. I remember
yeah,
people saying
man.
that.
I mean, it's funny because I did start out at Hampton, but home
Oh,
ownership brought me back to Philly,
oh
right?
wow.
So I had an opportunity to be a homeowner at a very young age, basically, but by second semester freshman year, sophomore
Hmm.
year, I had an opportunity to be a homeowner. Had a big old house on 52nd Street. That's how I met a lot of the people in our business, but well before we became realtors and investors and mortgage professionals. But yeah, home ownership brought me back to Philly. I would have met Lorenzo Jackson, who's a Hampton guy, a couple other Hampton guys we know, but I came back home to Temple.
Gotcha, gotcha. Okay, well, let's get into here. I know the people love to hear our stories, but they're probably really interested in, okay, how do I get a home? So when people come to you, like I said, if somebody comes to me directly, I always push them to get their finances straight because that's the first thing when dealing with, when looking to buy a home. So they have to be prepared to buy a home. I guess what's the biggest mistake that you see people do when they come to you when they want to buy a home?
Well, I think there's too many to count, unfortunately, right? Sometimes it's like that. I mean, one thing we always talk about, and I know I've shared on some of the some of my social media, is know your credit score,
Mm,
right? That's always one thing
right.
that you should know before you make a big ticket purchase. Is do you know what's on that credit report before that guy who's going to pull that credit, that guy that doesn't know you? Now
Right.
you're giving an opportunity for someone who doesn't know you intimately well to kind of formulate a story
Mm,
without even really knowing you, because a lot, us professionals that work in finance and credit,
hmm.
we can almost tell a story by basically on how people handle their bills. You can start to kind of put certain pieces together, and don't let a stranger be able to put a story together for you that you're not the author of, right? So before you even talk to me, before you buy a car, before you buy a home, know what's on that credit report. Know, um, what type of debts that you have. Can I get an idea of what your scores may be? Don't have a guy pull your credit and then you reach across the desk like, what? What's that? What? And
Right.
you're like 568. Like, it should not be the first time you heard that. Like, you should kind of already know what your credit score is, and what type of things that may be addressed before you even speak to a realtor or a mortgage professional.
Okay, so when I pull my credit, I'm seeing a bunch of scores. I'm seeing a core score from TransUnion. I'm seeing a score from Equifax. I'm seeing a bunch of these scores. I guess you being a mortgage professional, what are you guys looking at? Are you looking at all three of them? You looking at one of them? What's the case?
Good question. So most mortgage lenders are going to use a FICO, so that's different
Mm,
from a Vantage. we could start a whole nother session on how credit is scored
Right.
throughout the world of credit, right?
Right.
But mortgage lenders use a FICO classic model mostly, and what happens is it's three credit pool. It's a tri-merge credit report where
Okay.
Experian, Equifax, and TransUnion will all be scored.
Okay.
Usually, mortgage credit pools are trailing behind some of the current data that you might have in your cell phone, which also often adds confusion to home buyers. Well, they're
Right.
saying, "Well, that's different because I'm showing 680 here."
Right.
But a mortgage credit pool is entirely different from a credit card credit pool or an auto loan credit pool. It's quite different, but it's a FICO score, and mortgage lenders across the board, it's global, will
Mhm.
use the middle score, right? And not just
Okay.
middle because it popped up as the middle, but numerically the middle score. So if I got a
Okay.
700, I got a 680, and I got a 692. Well, the 692 would be right in between the 680
Mhm.
and the 700 scores. So that's what
Okay.
they use. They use the middle score in case one bureau really loved you and one bureau really hated you. They
Right.
use the middle score.
Okay. I do want to point out, because I get this question all the time. People usually use Credit Karma. They usually use Credit Karma because it's free. I understand. I got a Credit Karma account myself. Credit Karma is awesome for looking at the accounts that you have, but it's not good as far as the score because, like Shad mentioned, they're looking at your FICO score, which is different than a Vantage score. Credit Karma has the Vantage score, not the FICO score. So just make sure that you guys know that. And I mean, just to unpack what he's saying, you really got to know your own situation before you go in front of a lender, because again, you don't want that lender forming a story and you really can't explain nor back it up. So you do want to see it. So all right, so we got credit here, and shameless plug, but if people do need help with their credit, I do have a credit improvement program, so just reach out to me for that. All right, so we got credit. So Chad, I'm looking at my credit, and what should I be looking out for? Like, I guess what are the some of the key points that I should be looking out, and also what are the deal breakers? What are the things that, hey, listen, if you have this on your report, fix this before you do anything.
Good question. So I think mortgage, in terms of being able to qualify for a mortgage, is all about how you manipulate monthly debt, right? Because this whole thing is about this big old loan, but again, it's paid for in monthly payments.
Okay.
So this whole situation, this whole experience is based on how well you manipulate and manage monthly debt, right? So if you're going in for a mortgage and you have several things on your credit report, one, you want to make sure your payment history over the last 12 to 24 months is healthy, right? If you know you got some things to either remove or you were just late on the payment and you're about to apply for a home loan, is this something that you're really prepared for?
Hmm.
Is that late because it was just a kind of happenstance late, or have you been struggling over the last couple months before this application? So, payment history becomes a real hot topic because they're going to look at not only any installment lates, but any revolving lates. And again, payment history I mean, you have to have a good payment history to showcase that you can have the ability to repay a loan. I would say if you have any issues, and me and you spoke about this in a previous conversation, if you have any issues where any bills, especially bills that have anything to do with student loans, Department of Education, or the IRS, or anything that's pretty heavy, you want to make sure your payment history or any payment arrangements are good with them, right? Because you can't apply for a house knowing that you owe 5 grand to the IRS
Okay.
and haven't addressed that at all until now when it's time to buy a house, right?
Okay.
So again, any payment arrangements that we need to set up, we need to set that up well before we go on and buy a house. So that's why it's really good to maybe take a look at your credit report. There's various different ways, annualcreditreport.com, freecreditreport.com, to at least, they may not show you what your scores are, but they'll at least show you what's on your credit report. Same thing with Credit Karma. I mean, say what it is about the scores and the inaccuracy. It's good for
Mhm.
credit monitoring,
Right.
and it's good for being able to see again what your debts are. Get a grip on those debts before you apply with a mortgage professional. Definitely get an idea in terms of what you owe and how was your performance over the last 12 to 24 months.
So, Chef, are you saying that if I had a late 3 years ago or 5 years ago, that won't affect me as much?
That's a good question. So yes, chances are. So when we talk about, when we've talked to plenty of home buyers over our years in the business. You and I, we don't need perfect credit score, right? We
Mm,
don't need a credit guru applying for a house, right? We just
mm,
need solid credit. Who have you been over the last year? Who have you been over the last 24 months, right?
right.
It doesn't have to be this grandiose 800 credit score. And we obviously know too, you don't have to be rich to get how you manipulate and manage your debt, right? So again, a late from 3 years ago won't hurt you. A repossession from 10 years ago, chances are it probably won't hurt you. But who have you been over the last year can impact your, your eligibility for a home loan.
Okay. And I think you mentioned as far as taxes, we just got out of tax season. I'm sure tax season will be here before we know it like this. But if I do have problems with the IRS or I do have issues, I think I heard you say that I really need to have taken care of it maybe a year or two or just before I come to you trying to buy a home.
Absolutely, absolutely. And so we just mentioned again about the need for payment arrangements.
Payment
I've
arrangement.
lost a deal or so where, you know, we knew going in that
Mhm.
chances are this debt is going to pop up. You can advise a client, but sometimes clients, our home buyers will, well, maybe they won't find out. Chances are they will. So if you're listening and watching this, there
Right.
really isn't anything that you can hide from an
Mm,
underwriter or a title company, right? And so,
right.
unfortunately, I lost a deal where we needed to have a payment arrangement before the home buying process. And
Mhm.
unfortunately, we started it like the night or two before they went under contract. They made a payment right
Wow.
then, they made a payment during the process, but the underwriting requirement for that type of loan was three payments that needed to be made before closing. There was
Okay.
no way we were going to make the third. So unfortunately, the buyers couldn't wait. And we lost that deal. The expectations were at least set from myself and the realtor that we worked with that this could be a potential problem.
Hmm.
Buyers still wanted to proceed. He knew what the guidelines were.
Hmm.
We were very transparent, and unfortunately, we lost that house. So if you have anything that that really needs to be addressed, that you have fingers crossed that hopefully someone won't find out. Well, again, chances are they will, but you have to be transparent with your realtor and your mortgage professional so they can advise you and let hey, what's up? You know, good work on that payment arrangement a couple months ago. Or chances are they're going to find out. If you want to proceed, it is totally up to you at your own risk. But definitely, again, if I had any advice for someone buying a home, is you gotta trust your support system. You gotta trust your
Hmm.
realtor. You gotta
Right.
trust your mortgage professional. You gotta let these guys know everything up front, cards facing up. So that way we can be able to truly advise you.
Right. And I think that's a point of clarity because I see when people come to lenders, they may try to hide things because they think that the lender is kind of the face of the bank, where in actuality, somebody like you, a lending officer, and correcting me if I'm wrong, you're kind of prepping them to go in front of the underwriter.
Mm,
So if
yeah,
we can look at this, if we can try to kind of paint a picture here, you're kind of dressing them up to go on stage, and the stage is in front of
that's
the
an awesome
underwriter
analogy. Absolutely,
because
I use a couple of different ones, but that you couldn't get it any better. Literally, we're dressing you up, putting you in your Sunday's best. Because it's much bigger than me. It's much bigger
right,
than you. We're the
right,
faces of the transaction, but it is much bigger than us. A bank is going to let you go with 6 digits worth of money that does not belong to you,
mm,
right? And so we have to prepare you as best as possible and put together a case, again, that shows ATR, ability to repay.
Right.
And oh, by the way, none of us are going to be standing behind an underwriter explaining them. Yeah, see that right there? And see, that's when I worked at UPS. And then
Right.
I went and I started. No one's going to be explaining your bank accounts, your spending
Right.
habits, your credit history, your credit score, why you missed that payment. No, paperwork, documentation, and numbers are going to be able to tell that story well after you've submitted it to myself or Khalid. So again, the story that we put together has to look good. Would you look at as back when we were school kids, we used to do book reports,
Mhm.
and I mean, the teacher would get book reports in hand, and one has a really nice folder, and the handwriting is really nice, and they answered all the questions, and another guy, it's a lot of erasing and some words missing, and the folder's a little sloppy, and as soon as she opens up, the papers fall out.
Right.
Like, you gotta prepare a really good file. How do we do that? Well, we make sure job history is good. We make sure the credit is solid enough. We make sure that we went over the guidelines. That's my job, right? We make sure we went over the guidelines and everything to make sure that this loan is compliant. We make sure we got a down payment. We make sure, that this truly is the right loan product for us, which is
Right.
again my job. But like you said, we're preparing them for the big dance. You
Right.
can't go in the big dance with jeans on.
Not at all. Not at all. Now, what about some people who have child support? I guess where does that become a factor in the home buying process?
So, good question. Let's talk about it on both ends, right? Both sides, real quick, right?
Okay.
Without being too long winded. So, one, qualifying with child support or separate maintenance, alimony, any type of fixed income, right? Some folks will forget to mention that because they're thinking that's not real money.
Mm.
But my 9 to 5, punching that clock, that's real money, right? No,
Mhm.
that fixed income, actually, I appreciate that sometimes more so than your wage earning income because it's COVID proof, right? That money's either coming from the courts or from the US Treasury, right? So we like that money, right? So again, child support, spousal, out anything that you're receiving from the court system, as long as we can usually see it, depending on the loan product, that it's going to go out at least 3 years or more, we'll take it because we can use it and put it right next to your wage earning income to be able to qualify you for a loan. So we love that. And then
Okay.
on the other side, okay, if you're paying any of that money is outbound leaving you.
Mhm.
Essentially, transparency. Let your mortgage guy know, right? Because at some point, that has to be factored into that debt to income ratio, right?
Okay.
The actual debts that you have. A lot of states don't report child support on credit reports. So
Mm.
essentially, going in on the surface, Khalid and myself may not know, right?
Mhm.
But title company, underwriting, all those people behind the scenes, that's their job to dig up and find things. They may see that and find that, right? And so again, once they do, they'll see how much you pay, and that money needs to be associated and utilized in that equation that we come up with. Again, debt versus income, right? And so that'll be just another added debt. And if you're, kind of tight on your debt to income in terms of the percentage needed to qualify for a loan, that could be the deal maker or deal breaker,
Mm.
right? So I know we didn't talk too much about debt to income, but it is again one of the heaviest factors in terms of how we qualify a loan in the mortgage world. Your debts, your bills,
Mm.
things that are on your credit report that leave outbound
Mhm.
versus the income that you make. That is income meaning verifiable income that you pay taxes on, and we can verify that you do so through 2 years worth of tax data, right? And then again, like I mentioned, we can use fixed income, social
Mhm.
security, disability, alimony, all of those things that can kind of come in it. We can verify and that have some longevity that are
Okay.
going to still be around after this loan closes, then
Mhm.
we can use it. But definitely, again, there's that transparency, like you mentioned earlier. We got to tell folks, whether we're paying it or whether, again, it's coming inbound to us.
Right, right, right. The disclosure, disclosure, disclosure.
Big
Just
time.
let us know. Now, you're with a mortgage company,
Yeah.
and a lot of people, and you know us, we're conditioned. Okay, let me go to the bank. Let me go to the bank. Can you really like break down as far as the difference between me getting a mortgage? Well, first of all, the difference between a mortgage company and a bank, and what some of the advantages and disadvantages are to both.
Got it. So there's a couple of different classifications, right, that of folks that do our job. So I was just talking to another friend yesterday. A person went to a credit union and they've had tons of trouble in terms of communication, right? The
Mm,
communication wasn't there. The Federal Credit Union, it was a small one. Every time he did have dialogue, they were you could tell they were stretched thin. The staffing wasn't the same. And these were the same people that handled their direct deposit, their auto loan,
mm,
their checking account, their savings account, their money market, right?
mm,
So there's a lot of different, entities that could originate a mortgage loan. So
mm,
I'm what is called a mortgage banker. I work for a mortgage lender. I
mm.
work for one company. All right, and that company is Loan Depot.
Okay.
Now there are people that do my job, same type of licensing. They are mortgage brokers. Essentially, when they hang up the phone with you as the home buyer, they immediately start to call different companies that they have an affiliation with, and they look for the best particular product for you. Typically, mortgage brokers will have less support than a mortgage company, but there's also still pros in working with a mortgage broker. A credit union or a bank. Now, 10, 15 years ago, that was the primary way where people would think of home buying. They go right into their local bank. The same bank, again, that has a checking, an auto loan, a direct deposit. That used to be the way. And
Mm.
culturally, the people that we primarily serve, or especially in the Philly, Wilmington, and Camden areas, psychologically, they just figure I'm just go right down to PNC tomorrow and get a mortgage.
Okay.
That again, that's how our parents bought homes.
Right.
Uh, in the era that we're living in now, home buyers tend to pursue and have a greater frequency of success by going with a more specialized experience.
Mm,
Mortgage companies write mortgages,
mm,
right? You go to Target, you could get a pair of tennis shoes or athletic shoes, but chances
mm,
are a better experience would be at Dick's or Foot Locker, right? It's a
okay.
more specialized experience. I'm buying
Mm,
sporting goods at a sporting goods store. Very similar. I'm getting a mortgage from a mortgage professional because that's all they do. They're incentivized to close your loan. Chances are they may have, and me and you talk about this all the time, better products and
mm,
more flexibility in regards to approving you. Because
okay.
again, your mortgage closing keeps their lights on,
Right.
right? Where again, if I got 6 or 7 different ways to make money, I still got your checking, I still got your savings, I can still send out checks to you, I can still manage a direct deposit. You want to get an IRA through me? We can. I mean, there's several different ways a bank can still uh, keep your business, right? A
Right.
mortgage used to be well at the top, is way at the bottom now, and you feel it as a consumer. You feel it.
Mm,
I get more, and again, I have tons of friends in the banking industry across the board. So definitely not talking down, but I get tons of business from poor experiences had at some, mom and pop shops or different banks because again, it's not their bread and butter anymore, right? And what
mm,
we're either looking at tight guidelines and tight rules that try to make you fit into a box,
mm,
or again, the customer service experience is not the same because again, the staffing isn't the same, and again, it's no longer banks putting their eggs in that basket, right? And the
mm.
consumers feel that, and that's why
Right.
slowly but surely we've seen a turn where folks are like, all right, I probably should go to a mortgage guy, right? Because that mortgage guy, that's all he does, right?
Mm,
And maybe he has products that fit my needs better. And again,
right.
maybe he may sit at my kitchen table if I need it. Chase Bank is not going to sit at your kitchen table. No, right? Wells
Not
Fargo
at
is not
all.
coming behind the desk and walking out there and meeting you for coffee at Starbucks. It's just not going to happen. And that's not
No.
a slight to him, but that's kind
Right.
of where the business has shifted.
Right. Right. I mean, just to piggyback on that, just to add to that, I mean, just going above and beyond.
Yeah,
Somebody, a mortgage, and again, there's pros over here and there's cons over here. But one of the
for
things, if I
sure.
can just chime in, is that a lot of folks at the bank, they get paid a salary, where mortgage individuals, if the loan doesn't close, they don't get paid.
They don't get paid.
So their interest lies within your interest. But again, there's other things, reasons why people would go to a bank. So just kind of moving on here. Um, the different types of loans, as far as, I mean, really quickly, if we can just expound on the conventional FHA, 203K, just
Hmm.
those different type of loans, and what are the ideal candidates for each of them.
Good stuff. So, real quick, we'll run through these. So, you guys know, um, America's loan, as they say, backed by the government, meaning it's insured by the government, would be an FHA loan. Philly is the Philly greater Philadelphia area is a hotbed for that product. The pros of an FHA loan would be lower credit score requirements, low standard down payment, regardless of it's a single family home or multi-unit, up to 4 units. 3.5% minimum payment has kind of been just tattooed in a lot of our brains. We don't know anything about housing, but we know 3.5%. It's been the
Right,
same thing for years. And
right.
again, it's a safe loan for originators to write and lenders to write because again, it's insured by our federal government, right? And one con would be, regardless of what your down payment percentage, typically you're going to be paying mortgage insurance.
Mhm.
And so what that means is if again I'm not paying 20% down, I'm basically paying a small little portion that goes to the federal government every time I make my mortgage payment that goes to a central bank somewhere and is there stored in the event that myself or someone else somewhere across the country, anybody, defaults in their loan. This big old bank is building to help
Right.
bail basically everybody that was expecting your payment out, right? So it's a good loan because it's if you've had a story to tell via
Mhm.
credit, right? And we know again over the last 12 to 24 months you've been on the up and up, but you've had some trouble down the line, in the past. Or I have a client I did a loan for last summer. She was 660. We're doing a loan right now. She's at 585.
Oh,
You
wow.
figure, damn, what happened?
Hmm.
Unfortunately, she wrecked a car, and the way that car has been scored on her credit,
Hmm.
it's truly a disservice to her. But it looks like she defaulted on that car loan, but essentially, the gap insurance and all of that messy stuff, it'll be sorted out. But it
Hmm.
really hit her credit score really hard,
Well,
And when I looked at her credit report, nothing had changed, but this car situation. So it's really ugly. But again, if you have a story to tell, with that lower credit score requirement down to 580, and
right.
she's at 585. I literally pulled her credit last night at 9:30. Um, she is still able to make a purchase.
Okay.
She's still able to buy, right? And so that's the good thing about the FHA. So again, if you got a story to tell credit wise, you don't want to, have tens and thousands of dollars saved up for a down payment. You can still make a purchase. So conventional buying. Let's shift gears real quick. So
Okay.
conventional purchasing. Cool thing about a conventional purchase is over the span of the most recent years, they shifted gears and they too have a minimum down payment. If you got good credit, first time home buyer, you can do as little as a 3% down conventional, 97% loan to value, as they say, right? So 3% better than 3.5%, right?
Right.
Conventional loan, typically those with conventional loans, we say as low as 620, but
Okay.
that's it's very difficult to qualify for one at 620. Typically, we'll see usually best results around a 660, 680 range. You'll be able to qualify for a conventional loan. So
Okay.
again, I call that the Cadillac of mortgages, meaning that you tend to have better credit scores. They do also have a 5% down payment. It's kind of the standard
Okay.
for repeat buyers and different relationships. One thing I would say about a conventional loan, the strength or pro for a conventional loan would be the fact that the mortgage insurance is not tied to the loan for the life of the loan. So a lot of people would like to maybe they go in with an FHA loan because again the credit score or the minimum down payment made sense to them. But over time, as equity builds and as they pay the loan down,
Mhm.
they tend to either refinance or ask their mortgage guy, what can I do to get a conventional loan? What are the steps to change this loan out? Because again, that mortgage insurance, over time you can make the case that I am paying this money unnecessarily. I haven't defaulted, got great payment history. The loan to value, meaning the equity that I'm building in this property continues to go down. So conventional loan over time may prove to be the best loan product, but again, at a higher credit score needed. Again, the mid sixes is the bare essentials, but it's best executed at 7 and above. So, that truly longevity wise is the best loan product. Let's talk real quick about VA lending.
Well, hold on. Before you do that, I just want to do one point of clarity
Yeah, jump
as
in.
far as if somebody has a FHA loan, okay, they have to pay that PMI, which you're not really benefiting from. But when your equity is it 20 or 22%?
Good
Where,
question. Yep. So at 20%, you can start to make the case. That's when you start making phone calls to your mortgage provider to say, hey, I need this offer here, right? I'm at the 20%. Send out an appraisal guy if you need to, or look at the math. I calculated this is what the loan was. I now have 20% equity. And it's a conversation that you need to have with those who own the loan, those who you're making your payment to. Now, by law, at 78%, which is again 22% worth of equity, it has to be removed. And if it
now
goes on beyond that, you
it's
can
not
get
going to
retribution pay.
it's not going to be, if you're in an FHA loan, it's not going to be removed even if it's 50%. Is that correct?
Correct. Yep. Correct. It's on for the life of the loan. Most traditional FHA lending, if you're paying mortgage insurance, you're going to be paying it for as long as you're in that home, or as long as you're in that loan, I should say.
Gotcha.
With a conventional loan, you do have options to have it removed. Here's one for you. You even have options to pay mortgage insurance at the time of closing, paying a premium amount, right? There's lender paid MI, where essentially you take on a higher interest rate, right? And truthfully, basically, you're still kind of paying mortgage insurance, but you don't see it on your bill. But essentially, you're kind of paying it in the form of a higher interest rate. Depending on who you work with, they'll tell you that. But you can have several different options regarding your equity, your down payment, and the mortgage insurance, or the PMI, as they call it for conventional loans, private mortgage insurance, since it's a private loan. Conventional loans are private loans backed by Fannie Mae and Freddie Mac, right? Not the federal government, right? So I didn't mention that. But with those loans, typically, there are different options in removing the mortgage insurance. You can pay up front, you can pay along the way. But again, as Khalid said, once you're at 20%, now we're talking. Now we can get rid of this extra $100 or $150 or $200 that you were paying for all this time. That's a good savings, right? That's $2,400 a year if you were paying $200 a month extra for nothing, essentially, right? For paying your mortgage on time. So good stuff.
And most people, what I found, most people, if they do have an FHA, once they get to that 22%, they'll refinance it to a conventional loan and then get that taken off. Is that what you
Yep.
find?
Yep, absolutely. Absolutely. And again, it could be a matter of you paying down the loan, or as we're seeing in this marketplace now, and you can attest to this, we're seeing rising property value, right? We're seeing rising property value. I did a refinance for my oldest sister, right? And she calls me up and says, yo, I think I'm there, but I'm not sure. She was at 108. She thought maybe 130, 140 for a house. She wanted to kind of say, I think I might be somewhere near this 20%. Her house appraised for 188.
What?
188. Her loan to value went to like 50%, 55% or something like that. It was snatched off.
Wow.
Like, it wasn't just removed, it was snatched off.
Right.
The mortgage insurance.
Crazy.
And she got a lower interest rate. So now this is, again, the reason why we've seen the biggest refinance boom that we've ever seen, even bigger than 2016, is because we're not only seeing record low interest rates, but we're also seeing rapidly increasing property value. And put those two together, you got a lot of instances like that where if you're a current home buyer, current home owner, I should say, you can get more for your home than ever if you decided to sell. But if not, we know that you've built up a lot of equity in your property, right? And again, we're seeing two factors moving: paying down a mortgage, paying down a mortgage, paying down a mortgage, paying on the principal. but we're also seeing that rise in equity. Chances are you might be, in lieu of a refinance where you're not pulling out cash, but you're
Right.
simply, removing the mortgage insurance if you didn't put 20% down when you first purchased the house.
Okay. That was more than enough explanation, man. All right. So let's move on to the VA loan.
Yeah, VA lending. So if you served, right, and obviously if you have served and you're watching, let's appreciate you for all you've done for the country. VA lending, is it's a great product, and it's
Mm,
underused, undervalued, and I don't think there's enough advocates out here that help our vets purchase homes using their VA eligibility, right? And
mm,
so with a VA loan, there is no down payment, there is no PMI, right? So what does that mean? That means typically for purchases in our area, when clients ask me how much money they should save for a home purchase, I say, all right, well, look, um, 3 or 5% down payment, basically maybe 3 to 6% closing costs, right? So
mm,
basically take the purchase price,
mhm.
multiply it by 8, 9, 10%, somewhere in that range can give you an idea of what the transaction costs, both down payment, closing costs, miscellaneous fees and such,
Right.
right? Well, you're taking out a big chunk of that in terms of the down payment, right? Still got to pay closing costs.
Right.
Sometimes people don't really talk about that. Title company still needs to be paid for their work, right?
Right.
But no down payment and no PMI. And oh, by the way, typically the lowest interest rates across all of the loan products that are provided for home buyers in America. Now you're talking about a really, really good loan product.
Right.
Again, no down payment, meaning a big chunk of your expenses have been removed.
Right.
You're talking about no mortgage insurance. So basically, you're allowing me to finance 100% of what this house is worth. If this house is worth $150,000, you're going to give me $150,000 to buy this house. I don't have to come with 3, 5, 10, 20%. No,
Right.
I just got to pay my closing cost, right? And then you're telling me too, I'm at 100% loan to value. I mean, again, this house is right at 150,000. That's where the loan is, and
Mhm.
I don't have to pay that junk you just told me about. Went on this tangent about mortgage
Right.
insurance in case I default on the loan. Again, this loan is backed by the
Right.
government
Right.
in case you have any issues making payments. So I think it's the strongest loan product for the right reasons for veterans who serve this country.
Right.
No PMI, no down payment, usually typically lower closing costs, and then obviously again very low interest rates.
Right. And that's a small piece of the population.
Small
Um.
piece of the population,
Right.
unfortunately.
Right. Right. Yeah.
Veterans can use the loan. Veterans and their spouse,
And a
typically.
spouse. Okay.
Veterans
That's
and their
important.
spouse.
Okay. What's the next product?
Well, we have USDA. So USDA structured often like an FHA loan,
Okay.
where again it's backed by the government. People automatically think, oh, you gotta be living, you gotta be playing the banjo barefooted with a pair of
In the
overalls
farm. Right.
on
That's what I
and the
think.
farm. It doesn't it doesn't have to be that. The
Okay.
state of New Jersey has like 38% of New Jersey you could use a
Oh wow.
USDA loan. Like
Okay.
tons of, when you look at the map, there's tons of New Jersey within driving distance from Philadelphia that you could, in particular, use a USDA loan. So again, structured a lot like a VA and an FHA loan, low
Okay.
mortgage insurance. You can get in there with no down payment. You can get in with very low interest rates. You essentially where it's kind of inverted where you're trying to qualify and show how much money you make. I mean, I had a great year at work, so I know I can
Mm.
afford this. Well,
Right.
USDA loans, you're trying to keep a lid on your income, right? Because you
Mm.
don't, it's a loan for low to moderate income
Okay.
home buyers, right? So you don't want to show that you got, the biggest, baddest, income in the world.
Okay.
They do use everybody's income in the household, whether they're going on a loan or not.
Okay.
So if you got a teenager working at Wawa, they want
Hmm.
to know what that teenager's making because they want to again quantify accurately what type of income is made in that house and do you truly qualify for that loan. But again, a very good loan product. Going in if you're not living in the concrete jungles of Philadelphia,
Okay.
Wilmington, Camden, so forth. It's something that you want to look into or ask your realtor about or ask your mortgage professional about hey, does this home qualify for a USDA loan? Again, you
Hmm.
don't got to live on the farm,
Right.
so I would ask about that because it could be a good loan product. A lot of the same qualities as the FHA and the VA, and again, it's backed by Uncle Sam.
Gotcha, gotcha. Okay. What about the 203K? I mean, you hear all this buzz about this 203K out there.
Absolutely. So good call. FHA has a version called the FHA 203K, and the conventional has something similar called the conventional home style loan. Um, with the FHA 203K or the conventional home style loan, what happens there, guys, is you're able to not only purchase the house that you're looking for,
Hmm.
right, but you're able to also finance the repairs. Because any traditional loan, sometimes people say, "Well, I was approved for 300 grand and the house is 260. Can I get that 40 grand too?" No,
I
you
hear it all the
cannot.
time.
No, you
I hear
cannot.
it
The
all
bank
the
is going to
time.
give you what you were approved for that
Right,
particular home purchase.
right,
They're not going to give you anything extra.
right.
But in an instance where you're doing a renovation loan or construction loan, as it may be called, typically you're able to again purchase the house, and a lot of times these loan products are used for homes that are less than perfect. Let's just say that they could be
Right.
torn to shreds, or they could be livable but still need lipstick on a pig, right? And so either way, the bank is going to give us money to be able to purchase that house,
Hmm.
and in that way now that seller is able to be made whole, right? And then after the home purchase is like a traditional purchase, that
Right.
seller is able to go off and ride off into the sunset. And typically, you're given a time span with that budget, with that extra money that you qualified for. Once we know what the approved of ARV value or appraised repair value is
Right.
after it's been repaired, right? We're able to take that budget and help with general contractors that you selected because they
Hmm.
need to be licensed and insured, and those GCs, have now a timeline of how they got to handle, the transaction for the rest of the way in terms of here's the timeline, here's
Right.
all of the repairs your team said that would be needed. We need them done by this particular date, and so typically it's a good product for an inventory strapped market like we have now. An
Right.
inventory strapped
Right.
market like we have now, meaning there's not a lot of homes out there.
Right.
But we all know where a jacked up house is on our aunt's block or a couple doors down, or you drive to work and you ride past a couple homes and you say, wow, that'd be a really nice house, if it had the bones. Or you're shopping with Khalid and he sent you 10 homes, 8 of them are turnkey, but there's 2 that stand out to you, and you figure, wow, just with a little bit of work, I can make that house something,
Right.
right?
Right.
Well, most people will want the turnkey, right away satisfaction of just walking in and getting started.
Right.
Well, if you got a little time on your hands, you know your way around some repairs, you got a team that you feel confident in. Hey, look, I know a
Hmm.
contract, he's good. Consider it because it allow you to maybe buy a house at a lower price.
Right.
But again, now instead of you using your bonus money from work, you using and running through your savings account, the
Right.
bank is giving you money to finance these repairs. Have one loan payment. You still only have one mortgage,
Right.
right? But where else would you have gotten this money from, right? And now you know you're going to get it done, and typically 6 months is what they give you. So you
Right.
got 6 months to get this stuff done
Right.
versus
Two,
6 years, maybe.
right. Two points of clarity.
Yeah.
So if I just say the house costs 100,000 and the rehab costs 100,000, so is a 2 or 3K loan? Are they going to give me? We're going to pay off the 100,000, and then I'll get the $100,000 in my pocket, and then I'll pay it to the contractor.
Ah, good call. So essentially, one, they want to appraise the house and make sure that the house could support $100,000 worth of work,
Okay.
meaning that you're qualified for a loan where, let's say it's going to be 200 ish, right? That you're qualified for that, that the ARV is supported by the comps in the area,
And
right?
the
Because they're
ARV
not,
is what? Just so everybody knows, the ARV is
yep.
what?
So the after repair value, right?
Okay.
So you want to make sure again that we're not going to throw $100,000 in the house that's only going to be worth 125 grand based on the comps in the area, right?
Oh, so I can't get this 2 or 3K if the house just needs the floor done. I'm walking in the house, it's moving ready, it just needs the floor done.
Correct. Correct. So no lender, no bank wants to see you underwater,
Okay.
right? So they don't want you walking around with a mortgage loan for $175,000. But again, the property at its best is $130,000. Because what happens when you go to sell the house, right? Again, you're going to be underwater, right?
The
Because
short sale waiting to happen.
short sale waiting to happen. That 40 grand that's got to come from somewhere. Chances are it's going
Right.
to come from you.
Right.
So again, the numbers have to make sense, so to speak,
Mhm.
right? You can't pour $100,000 into a house that after you do, when you bought it for 100K, again, it's only going to be worth 125. So again,
Right.
the numbers got to make sense, and they're going to send out an appraisal, and you'll know, right? So again, fast forward, you got the loan, you qualify for the amount that you were looking for,
Mhm.
and then now the loan's done. Again, the seller walks off, he's done, he's paid, and now it's just you, mortgage company, your GC, and typically if it's a 203K, you'll have a consultant.
Right.
And then that money, that budget that you have is never going to really touch your hands in one lump sum and you and your guys are at lows. Never going to happen. So you identify the work that needs to be done early in the
Right.
process, you and your
Right.
GC, and there's certain bids, there's certain jobs. All of those jobs are recorded. And the
Right.
money is dispersed based on the completion of one job, and now you're to the next, right?
Okay.
They're sending out the money to you and your guys. You and your guys are paying for the resources and getting the work done, reporting that you've done the work. Now we move on to the next job, and we're just literally just going down a list. And you're getting the money based on the funds are based on the jobs being done on an itemized schedule
Okay.
versus here's 50 or 60 grand, see
Right.
in 6 months. It will never work like that.
Now, because of course, not multi-level, multi-family properties are that's the hottest section of the market. So if I have a 203K loan and I'm looking to get a triplex or a quadplex, will the bank take that those prospective rents into play when they say, okay, we're going to give you this amount of money, X amount of money?
Typically so. Yeah, so you can definitely basically when you're buying a multi-unit property, you can definitely let your lender know and say, hey, look, well, obviously I can't live in the mall.
Right.
So, here are the rents that I'm expecting. Here are the going rents for that area.
Mhm.
Excuse me. And those rents, that money that is in bounds, can be used alongside with your wage earning income or your fixed income that you are
Okay.
already using.
Mhm.
If you have any current rentals,
Mhm.
right, that you have in play and you're receiving rental income and you're paying taxes on that rental income, very important, folks. You can definitely use it be used part of that equation as used to qualify you. So absolutely, very good question. You can certainly use uh, rental income, even if you're not receiving it yet, but
Mhm.
you're anticipating it. And it's obvious, again, if you're saying, hey, I'm going to live in the downstairs, but I got two, above me, whether this is a 203K loan or not, I'd like to use, some of that rental income. Now, depending on the loan product it is, you
Mhm.
know, um, there's usually a cap. It may, say 75% of that loan
Okay.
income, and we can always go and talk a little bit more intently about guidelines. But yes, you can certainly use rental income that you're not collecting yet, but you anticipate um, in terms of qualifying for a loan.
Gotcha. Gotcha. Okay. Well, we're gonna wind the show down here. This is the last thing I kind of want to ask about is pre-approvals.
Yeah.
Pre-approvals are super important to my job because I really can't go out and show people homes without that pre-approval. So on the lender side, what do those pre-approvals mean to you guys? And I guess what's a way for me to if I want to get a pre-approval, what do I have to do?
Good question. A very, very vital part of our jobs, obviously.
Gotcha.
So again, you want to be a home buyer. So you want to be a home buyer, right? So
Right.
usually the first move, right? Literally 99%. I'm calling Khalid. I worked with him before, or my
Mhm.
friend told me that he got them a house, or I Googled him, or I was on Facebook. Khalid, he's my guy. Anybody that does Khalid's job or is Khalid himself is going to recommend that before the conversation goes any further, and they're not going to be rude to you, hopefully,
Right.
right? But they're going to say, hey, I can talk about houses all day long with you,
Right.
but you need to see what you can spend, right? You need to see what you can afford. How do you
Right.
do that? You have a conversation with a mortgage professional, right? Because then they're going to prep you for here are the steps, here are the things that we need. Again, income, credit, employment. If you guys have followed, anybody has followed me, I always talk about my big three: income, credit, employment. What's your job history like, right?
Mm-hmm.
What's your income? Is it verifiable? Are we paying our taxes? Can we prove it, right?
Mm-hmm.
And the credit, right? What's the credit like? What are our scores? But also, what are our debts? What is our baggage,
Right.
right? And again, all of those things help you qualify for a mortgage. So you had a dialogue. Typically, you'll fill out an application. You'll follow up with your mortgage guy. He tells you where to go from there, and then you start to retrieve certain documents that your mortgage guy tells you to retrieve: pay stubs, bank statements, W-2s, tax returns, and some sort of ID.
Gotcha. Gotcha. Okay.
And then hopefully we
Now,
can pre-approve you, and you can go shopping on the weekends with this man.
so the pre-approval, what's the difference between a pre-approval and a pre-qualification letter?
Got it. So a pre-qualification means you had a professional um, consultation and that you at least filled out an application. And
Okay.
typically it may stop there. So I had a conversation with a guy. All
Mm-hmm.
right. Not disrespecting or undervaluing. I had a conversation. I even filled out an application. He then calls me back, or I followed up with him, and the loan works, right? It works. This is, generally speaking, this is my purchase price. This is my comfort zone. This is what I can afford. But we have not yet verified employment. We've not yet verified income. We have not yet
Mm-hmm.
looked at W-2s and tax returns.
Okay.
So those things would be needed to complete a strong pre-approval process. So when you are walking around with a pre-approval versus a pre-qual,
Mm-hmm.
realtors, listing agents, buy side, you know, people in the space of real estate, they're assuming that you took it one step further and you threw some skin to lose in the game. You threw out some sort of, hey, here's verifying that I made 100 grand last year. Here's my
Mm-hmm.
W-2s, or here's my pay stubs. You can see this is what I got paid last week, but also you can see my YTD, my year to date, and then that'll show you that this has been me the course of this year, right? Because underwriters like to project where you're going to finish by the year's end, right?
Okay.
But here's something that I've done to verify that brilliant application that I completed. So that's what I would say is the difference between a pre-qual. At least they filled out the app. At least they got their
Okay.
credit pulled,
Mm-hmm.
right? But did they do any other something to verify that they're good and they have the ability to repay this loan and that you should be spending your Saturday afternoon shopping with them?
Gotcha. So from hearing you correctly, the pre-qualification is all the information without being verified, and then most of the time, the pre-approval is after those things have been verified.
Absolutely. Well said. Yep.
All right, awesome, awesome, man. Well, listen, man, you've given us a whole lot of information, Shad. If somebody does want to do business with you, where can they find you at?
So I'm on all social media platforms. I leverage my business via social media so I can be easily found on LinkedIn, Facebook, Twitter, Instagram. I'm Shad Knows Loans at Instagram. I'm Shad Hammond on Facebook. I'm Shad Hammond on LinkedIn. Uh, my website is loandepot.com/Shad Hammond. So I'm pretty easy to find, guys, and I would love to work with anybody that is a first-time home buyer or a fifth-time home buyer, a downsizer, or an investor.
All right, y'all. There you have it. Shad Hammond, the first guest on the Bull Ring. We'll be coming to you every Friday and bringing different individuals in real estate so you guys can kind of get what goes on behind. We're going to pull down a curtain and see what happens in their business. But number one, we're going to try to give you guys information that you can use to save money out there when you're buying a home. It's Khalid Nathan Aleem, the real estate boy. If you're looking to buy a home, sell a home, or invest in real estate in PA, in Delaware, and now Jersey, I
Now
got you.
Jersey.
Right.
Now Jersey. Congratulations, man. And definitely
Appreciate
appreciate
that.
the opportunity. Tons of value added, man. Good show. Good start, man. Congrats, and I know you kill it.
Awesome, man. All right, y'all. See y'all next week. Take care.
Peace and blessings. Thanks for watching.